Kenneth, fantastic to have you back. Thank you for joining us. Kenneth, what's your market view? For the longest time, you've been making a case
Morning,
to
Nicholas.
buy into the rural economy, focus on the agrarian economy, and that part of the market, that part of the economy is now firing.
I mean, from a very broad perspective, I think markets playing catch up with things normalizing itself, and I think a large part of that has already been done. So everything, I mean, from an economy perspective, company perspective, and also from a indices perspective, all utilization levels and indices have come back to a pre-COVID era. Okay, incrementally from here, it depends upon which part of the economy actually grows. So in the near term, quite obviously, there's been a huge stimulus to everything that has been non-metros, which is a large part of smaller towns and rural India, and that's showing reasonable amount of traction out there. So companies that operate in that part of the world have been seeing good volumes, good growth, and I could say fabulous numbers coming through. But that continues to remain a very small part of India. It's not going to be something that is going to be large even 10 years down the road. I mean, the big story is how India urbanizes, which part of manufacturing or services gets a leg up in terms of growth or grows faster than the average GDP. I think we got to look at all those characteristics before taking a longer term picture of what's going to be into the next decade.
When we spoke last, you had decided that you will not buy the crowded trade in the market, or that time's crowded trade, which was banks. But now banks are not crowded. Banks, in fact, is the underperforming trade. So is it time to switch sides?
So if I just look at an industry cycle that goes through, and if we just go backwards to about 2008, 2006 to 2010, so that's a 5-year block that you've got. And at that time, it was characteristically everything that had to do with capex, commodities, and corporate banks. In fact, none of them came through in the entire decade. The decade that went through is got everything to do with consumer leverage, and to a very large extent, companies or private sector banks, which effectively were reasonably large in growing that market share. So if I had to look at it from a cyclicality point of view, stock prices might have come back, and it may not be the most overowned part of the market right now, but stock prices have come back. We will have to go into December and probably the first quarter to see whether it really, I mean, whether as a sector, I mean, when you talk about that trade, if that entire sector needs to be allocated capital to. One or two isolated companies out there, yes, I'm sure they will continue to gain market share. They'll continue to increase footprint. They'll grow despite all the odds. But from a category wise, from a sector wise, I still think we'll have to wait to take that call.
Sure. Kenneth, on the financials, let's just focus our attention for a moment on the financials. Cyclicals, a part of the market that everyone feels is now going to really evolve along with a recovery. Are you also betting on a recovery? We've been debating V versus K, and assuming V for the part of the market that clearly is rebounding. How much of that do you see really filtering into some of those pockets that have otherwise been lagging so far?
So I think the V is already there. I mean, you can extend it by a little, but you're back to where you started off. Here you've got to be reasonably selective on what you're going to allocate capital to, or what you're going to buy. And if you're going to buy any of these companies, you should have a fair bit of visibility on what the quality of the book is, okay, how much they're going to grow, and where valuations stand. I mean, historically, I've not been in the camp that I pay enormous amount of valuations for a good company. okay, or high valuations for a good company. I haven't been in that part of the world. So if you have to, so for me, I mean, it has to be a good business. It has to come at reasonable growth, and you should also have valuations in your favor. So in short, the risk reward in some of these names have to be extremely high for us to have an allocation out there. So I'd wait and watch. I mean, I wouldn't want to be bearish on on these names, because some of them will do extremely well. And as far as the recovery is concerned, I think the recovery is already there in stock prices.
So, Kenneth, do you see merit in now moving into the broader markets as well? We've seen an incredibly polarized move when it comes to some of the segments or the key heavyweights. Do you now see broader participation?
So the interesting part of where India stands, or corporate India stands right now, and when you talk about the breadth of the market, you can, I think at least 30 or 40% of corporate India is sitting with huge amount of surplus capacity. So the main challenge for all of us going forward, maybe in 2021, 22 and 23, is where will demand come from? Because if demand comes from, I think utilization levels will go up. I mean, balance sheets will continue to get cleaned up, and then you will get growth coming through. So yes, manufacturing is already there, which is the breadth of the market. Services is already there, which is the breadth of the market. Everyone's sitting on capacity. That capacity necessarily needs to get utilized. We have a demand problem, not so much of an issue of a capacity problem, and corporate India can deliver. I think if you look at the transition in balance sheets over the decade, whether it's infrastructure, whether it's contracting construction, whether it's manufacturing, to an extent IT, and even the chemical and pharmaceutical businesses, everyone's reasonably well capitalized. Everyone's sitting with no one's really speaking of over leverage or leverage at this point in time. So I think we're very well positioned. The challenge out here is when will demand come back, and from where will it come back? Once that flips over, once that question's answered, or once demand comes in, I think we're pretty much okay going into the next 2 or 3 years.
Kenneth, would you tactically position yourselves when it comes to Bharat versus India? Because up until now, what one has seen is that the virus has been pretty aloof from the rural end of India, and which is why the rural-led recovery is what we saw from March up until now. But now, do you think that trade may be a little well-priced in, or a little toppish? I mean, the likes of an Escorts, M&M, even the rural FMCG plays, cement to some degree, they've all done well. But is it now time to make that switch, or would you say now with this wave of second lockdowns coming in, what with what's happening in Gujarat, or for that matter Madhya Pradesh as well, which was implemented over the weekend, stay put with the rural theme?
So when it comes to the pandemic that is there, I think that is already priced in. So somewhere the world economy is going to move on, including India is going to move on despite the pandemic that is sitting in this environment. Governments across the world and central bankers across the world are going to make sure that there's enough liquidity to take care of places which are or of countries and places which have a problem of a spike in cases out there. So I really wouldn't worry about this event, because once this event is behind us, you necessarily need to choose verticals of the market or the economy that will do well. And I think that's where our tactical shift has been. So if I put a broad perspective to it all, the Indian economy could tend to be reasonably weak over the next couple of years. Okay, when I say reasonably weak, I mean we have a deficit problem, whether it's at the government level. So when you have a deficit problem, you do not have growth capital to stimulate the domestic economy. So somewhere we have to look outward to generate that demand, or to make sure that your capacities get utilized. And that's why our strategy is slightly moving towards companies that have capacity, companies that can go, that can take this capacity and are competitive in the international market, and the substitution effect of some of the other manufacturers in global trade. Okay. So in short, if I link two of them together, or some of the parts that I've put together, the India trade today is just about 3% of the global economy. 97% is international trade. If we can get our companies, or a large part of our companies, manufacturing or otherwise, into that global trade, we will deliver very large businesses out of India. We've done it in the past. I mean, if you just look at the pharmaceutical business, or even the IT business, we are very close to 50% of volumes that are of volumes of offshoring or generic pharma that is there in the US. And there are a number of smaller industries also we have done it. This time around, I think we can do it on a much broader scale that is there, which answers the other question as to, will the breadth of the market come back, or is it time to start looking at the breadth of the market? So from an opportunity scale, don't look at India only in context. India will do well, okay, but we have our limitations. The opportunity, and if you look at currencies, and even if you look at a little bit of what's happening on the reallocation of global trade, India can find, or Indian companies can find their footprint in there, and we've done it before. I'm sure we'll do it at a much larger scale in the next couple of years.
On the subject of IT and pharma, though, Kenneth, you think, at least for now, the good news is in the price, and would these sectors now take a backseat, as has been the case the last 2 months?
They're well priced. I mean, everything's done well, and IT and pharma is no exception, and they're reasonably well priced as far as the market environment is concerned. So will they take a backseat from here? I mean, there'll be a couple of them that will continue to do well, but I don't think the entire block of these companies will do exceptionally well as they've done so in the last 18 months or so.
Right. Ken, let's look at the cyclical part of the economy. The general view is that interest rates are low, fresh capex will start, and that will generate demand automatically for cement, steel. Low-cost housing is already in back on track. Is there merit in looking at the cyclical aspect of the economy, the non-agriculture cyclical aspect, industrials, cyclicals?
So they're doing well. They're doing well across the world. So I mean, if this was a month back, it was definitely worth a mention. But a lot of them have already crossed where their book values have been. Okay, so they are no longer very cheap compared to where they have been in the past. But structurally, there are some industries. I mean, take steel, take cement, that have formatted themselves in a way that the top 4 or 5 companies in the country account for virtually all the profitability in the sector, or all the capacity in the sector. So irrespective of what's happening on the ground, and the ground demand is coming in simply because simply because there's been a pileup of a lot of work that has gone through in the last 6 months. All of it has come together in this quarter. So yes, there is a trade out there which is available, but I'll be very focused on how much I'll pay for each of these. I'll be very focused on how much I'll pay in terms of valuation for some of these names out there.
Okay. What should be return expectations, considering that we are not at the low point of the range in terms of valuations, but we are at the low point of the range in terms of a new earnings cycle? Is there scope for P expansion and earning expansion for equity investors, considering that interest rates will remain low? Because whatever we may argue, Kenneth, ultimately we know that market returns are a function of entry price, earnings, and underlying interest rates.
So, Nikunj, I mean, there's no simplistic answer to that, okay? Because if you look at valuation cycles over long periods of time, they usually spike in one particular part of the economy. So go back to 2000, it was only in IT. You go back to year 2008, it was only in capex, infrastructure, etc. You go back to 2015, it was in pharmaceuticals. Okay, and if you didn't have any one element of some of these names or a large part of these names in your portfolio PE expansion was not dramatic. So yes, I'll be I mean, price earning multiples always expand. You take the case of what's happened in businesses like Escorts or any business which is there in the rural part of the economy, or in this decade you take it where it comes to the FMCGs or the consumer part of the economy. So price earning multiples will only expand. I'm just saying that look for places or look for parts of the market wherein multiples are at the rock bottom. Look for parts of the market wherein the consolidation is through. Look where capacity is available and business and companies can grow without new capacity on the ground. And once you've allocated out there, then probably a 12-15 times multiple can go to a 30-35 times multiple. I'm not very sure of some part of the market which is already trading at 25 going to 35. I mean, there's no art to it, there's no science to that. There's just hoping that multiples will expand in perpetuity. I think that's not the way we look at it. So a little bit of the case I made before, don't look at India because we will have our challenges. I'm sure interest rates will be low this decade. I mean, in the 90s it was mid-teens. Last decade it had come down to low double digit, extreme low double digit. The decade that's just gone by, it was single digit, and it's going to go lower. So interest rates are trending to much lower, and there are fundamental reasons for that. So yes, there will be an expansion of multiples, but it's not going to be across the marketplace. There's some part of the economy that's going to lead markets higher. You've got to allocate capital out there, and you've got to, and then you can participate.
My last follow-up question, Kenneth, is let's divide the market into, let's say, two broad parts. Something where you are happy to buy for next 1 to 3 years, more like a cyclical bet or more like a market gain share bet. What would be that pocket? And what are you happy to own beyond 3 to 5 years, which could be called as a structural compounder?
So simply put, I mean, look at a whole host of businesses that have got manufacturing. Look at them with capacity utilization. Just allocate capital out there. So go back to the 90s again. I think we'll have a repeat of what's happened in the 90s right now. You had engineering, you had IT, you had pharmaceuticals and chemicals do extremely well. My sense is that will do well this decade, and you'll have a couple of more businesses that will participate with that. So on a structural basis, that's where I'll put most of my money. A lot which is focusing outside the country, a lot which is focusing outside. And in the next 2 or 3 years, there are some elements of valuation plays which exist. I mean, contracting construction hasn't done too much for a long time. Cyclicals haven't done too much for a long time, which is essentially the metals, cement, etc., which you've highlighted. So there is a valuation cycle. The valuations will act in your favor there, at least in the near term. But in the longer term, you'll have to figure out which companies are getting market share and how many of them are dominating the international trade. How many of them are dominating their verticals, both domestically and globally.
All right, thanks for joining us this morning, Kenneth. Always good chatting with you, and clear strategy coming through there as well going forward.